This is Conversations, a weekly financial podcast featuring interviews with leading investment strategists, noted technical analysts, and other key thought leaders. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA Podcast Series, and today's guest is Jeff Clark. According to Clark, the stock market has a long history of humbling those who feel pretty smart. Jeff Clark is the editor of the S&A Short Report, an investment advisory which focuses on short-term options trading. Jeff joined Stansberry & Associates in 2005 after retiring from his private money management business at the age of 42. Before joining S&A, Jeff was president and chief executive officer of an independent San Francisco-based brokerage house and private money management firm. Jeff also served as a consultant to one of the country's largest options market-making firms, developing the curricula for an international MBA program, and is the founder of an investor education firm. Welcome to the program, Jeff.
Thanks, Lance.
Well, let's start at the beginning. Tell me how you became interested in the financial markets.
Well, I guess way in the beginning, it goes back a long ways. I've always been interested in numbers, and when I was growing up as a kid, I was kind of a little bit of a math geek and big fan of statistics and working things out, so I was a little bit odd at that point. But I also had an uncle who was, let's just say he was a little bit of a gambler. And I was always intrigued by the whole idea of risk versus reward and how to use statistics or numbers to kind of tilt things in your favor. And, I don't like to convey that investing in the stock market is like gambling, but the fact of the matter is, anytime you put money on the line for a stock to move up or down, it is a little bit of a bet. And so what I wanted to do is find some sort of a way to make that work in favor and put the odds in favor so that the risk-reward is always tilted on our side.
Okay. How do you approach the market? What are some go-to tools in your trading toolbox?
Well, I'm predominantly a technical trader. I use technical analysis, but I might not use it quite the way that most folks do. See, when I look at a chart, I view the chart as sort of a psychological assessment of what the market is, or a psychological assessment of what the stock is. A chart shows the emotion behind the stock. And what I like to do is I like to look for extreme conditions. When stocks either get incredibly overbought or remarkably oversold, to the point where the rubber band the proverbial rubber band is stretched a little bit too far, and then make a bet that things come back the other way. It's sort of a reversion to the mean philosophy, if you will, and that's sort of the basis behind my strategies.
Okay. Well, you have a knack for picking tops and bottoms. What are some of your favorite timing tools? Are they strictly psychological, or do you quantify do you have tools that quantify the turning points?
Well, as much as you can quantify them. The technical analysis is more of an art than a science, although we try to make it more of a science. What I like to look at is different indicators, like sentiment indicators. Look for those to reach extreme conditions. I use Bollinger Bands to help indicate when a stock or an index has moved too far out of a normal range. I like using the relative strength index. When you see readings above 90% or below 5%, I think those indicate some extreme conditions. So there's a lot of different indicators that can sort of pinpoint where extreme conditions exist. And then it's a matter of finding those conditions and then finding some sort of an option play that allows me to make a low-risk bet with the possibility of very high rewards.
Okay. So there's a few things that you threw out there that I want to touch on. The first thing is, how do you approach a trade? How do you screen the multitude of securities and markets, for that matter, to get down to a high probability, low risk trade?
Well, there's no shortcut to it. I do look at a phenomenal amount of charts every day. I'd say I probably peruse, several hundred to maybe 1,000 or even 2,000 charts over the weekend, and look for patterns that I've seen played out before. In my writing, I often talk about rising wedge patterns and falling wedge patterns and double top and M's and W's and all these sorts of things. And I look for situations that seem to have played out before that have a high probability of playing out again. And if I can take those patterns, and add to that extreme conditions on some of those technical indicators we just talked about, that usually leads me to what I think is a high probability setup.
Now, when you mentioned patterns, the first one you mentioned was a wedge. Is that your favorite pattern? Is that the one that jumps off the page to you?
Well, it is right now. Technical analysis, much like everything else, things change, and you sort of have to adapt with it. And the wedge patterns seem to have let's just put it this way, I've had the best success this year with the wedge patterns. Other patterns haven't been quite as consistent. So, yeah, when I think about what I'm trading right now, I do look for the wedge.
Okay. What are the risks trading a wedge pattern? They're a bit slippery at times if they don't break the right way. Is that correct?
Yeah, well, you know instantaneously if you're right or wrong. I think that's the benefit of it. Most of the time, if you have, for example, a rising wedge, which is a higher highs and higher lows, where the distance between those highs and lows gets more and more narrow, so it forms basically a triangle. And you want to look at shorting stocks in that position as it gets closer and closer to the apex of that triangle. And the closer you can get, the less your risk is, because obviously if it breaks the triangle to the upside, you're wrong and you get out of that short trade. And if it breaks the triangle to the downside, you're immediately correct and can take a payoff pretty quick. And the same is true in a reverse condition where you have a falling wedge pattern, which is a bullish setup, where you have lower highs and lower lows, but the distance between those highs and lows gets more and more narrow. So it contracts and forms a wedge. And most of the time, and I'd say probably better than 70-75%, those wedges break to the upside. And of course, if you're wrong, you know it right away. It breaks to the downside, and you exit the trade at a small loss. But if you're right, it could be a very nice payoff.
Mm-hmm. And how do you know when you're wrong? Do you look for an intraday break the wrong way? Do you look for a close outside of that wedge the wrong way? How do you determine when this is it, I'm wrong?
Well, it depends on the length of time of the chart that I'm looking at. Most of the time, the best setups are always going to be on daily charts. And if I find a setup that's on a daily chart, then I'll look at the closing price to tell me I'm wrong or right. If I'm looking at, for example, I'll often use 60-minute charts. Then I have to consider intraday moves, inside or to the downside or the upside of a wedge, because that'll tell me if I'm right or wrong intraday, and I'll use that to set my stops during the trading day.
Mm. So how do you factor in sentiment into your work? How do you measure that? There are many sentiment services out there. Some people use indicators or oscillators for sentiment. How do you best measure sentiment?
Well, you're right. There are all sorts of indicators, and I think sometimes it gets kind of muddled. You've got sentiment indexes. The American Association of Individual Investors has theirs, and a lot of folks pay attention to that. And I think it's become one of those indicators that loses its value because so many people are paying attention to it. So I like to use stuff that's maybe a little bit less common, that's more in my particular circle of friends, for example. If everybody's talking about stocks or everybody's talking about gold, I know that the sentiment towards those is a little bit too bullish. So I pay very close attention to what my friends are saying, or to what my gardener is saying, to what my mom is saying. I've often referred to the mother indicator as being probably one of the best sentiment indicators I have. And that's anytime my mom wants to buy stocks, I want to go the other way.
Right. You said that you primarily express your views on the market through options. Is that correct?
Well, I prefer to use options to trade the market. That's correct.
Okay. Are they simple strategies? Are they complex strategies? How do you go about that?
Well, it varies, but what I like about the option market, and this is where I think a lot of people make mistakes, options are really designed as tools to reduce risk. Rather than buying 1,000 shares of IBM at $180 and putting up $180,000 at risk, you can buy the right to buy 1,000 shares of IBM and put up maybe $3,000 or $4,000. So your risk is maximized at that. Where most people make a mistake with options, and where you hear a lot of horror stories, is rather than putting $20,000 or $30,000 into a stock, people will take the entire $20,000 or $30,000 and throw it into an option, and that's just insane. Rather than reducing risk, what they've done is they've exponentially increased risk because they control many more shares than what they would have otherwise purchased. So the idea behind options is to use them as a way to control your risk. I know going in whatever I put into an option trade, that's the most I'm ever possibly going to lose. And so I have to be willing to risk 100% of the funds I commit to that option trade before I place the order. And if I'm willing to do that, then I know what my risk is. And again, that way I don't get, the emotion of the trade doesn't get, I don't get overwhelmed by it. In other words, if it goes against me, I don't start second guessing whether or not I should get in or get out or add to the position or otherwise. I've already made my maximum commitment. I know that's the most I'm ever going to lose. And if I'm comfortable with it, then it's okay. I can sleep well and not worry about the risk. Meanwhile, if I'm right on the trade, I can usually make just about as much as I would have dollar-wise with a full position in the stock.
How do you manage the time component, meaning the option will expire at some point, so you have to be right within a certain period of time, correct?
Sure. Well, that's always the tricky part, and that's where looking at the patterns and looking at the indicators come into play. Technical analysis is really designed to help pinpoint the timing a little bit better. And, for example, if we go back to the wedge patterns we talked about, the closer you can get to putting a position on as that stock is approaching the apex of the triangle, the more likely you're going to have enough time in that option. So you buy options with enough time to allow you a little bit of wiggle room, but still allow you enough time to get the trade off.
So you've had a career that's seen several market cycles. You've seen three market crashes. What are some of the more memorable, what's a memorable market call or trade that you've had in your career?
Oh, gosh. The ones that are most memorable are the ones that most people call me an idiot for putting on, and then I managed to stick with it and be proven right.
And you're the hero at the end of the day?
Well, yeah, I'm the hero for the ones who stayed with me and not so much for the ones who went against. I know the one that I refer to oftentimes when in conversations and in speeches is going back to 2000. That whole dot-com bubble thing was it was so outrageous. And I had a couple as clients. They'd inherited some money, and they asked me to manage the money for them. And I think in 1999, I had made them 70% on their money. It was a pretty good chunk, but they fired me because their next-door neighbor put all of his money into the Munder NetNet fund, which was a fund of internet stocks, and that was up 300%. And I refused to buy that fund with their money when they requested it. And it was simply because I couldn't understand the valuations. I didn't understand how the market was treating those stocks at that time, and I wasn't comfortable investing client money in that particular sector. And so after making them 70%, they fired me because they thought it should have been much better, and they transferred their entire account in early 2000 to the Munder NetNet fund. And, well, we obviously know what happened to internet stocks after that, and I think the fund lost something like 80% of its value over the next year. And so it was just one of those. I think most of the memorable situations are always going to be those where they seem to run so contrarian to what the groupthink is or the public thought process is at the time. So, I mean, that's one. In 1987, I can go back there, and I remember turning bearish on stocks in April of 1987 and being wrong for a few months and having to fight that battle. And, of course, we had the stock market crash in October, and everything was proven right. So there's a handful of calls like that.
Sure. Well, where do you think we're at right now in the market? Do you think we have 70% returns on the way, or are we going to see 80% on the downside?
Oh, well, you know what? I started turning bearish a couple of months ago. Not aggressively so. Just there are certain things that are happening right now that line up so well with important tops we've seen in the market in the past. And just a little bit of history. The market seems to make an important top just about every 6.5 or 7 years. And you can go back in time. You can look at the 2000 top, and then 2000, 1994, 1987, 1981. And you just keep going back, and it seems every 6.5 to 7 years. And there are certain things that seem to happen every time, and they're happening again now. It's been 6.5 years, or a little over 6 years, I should say, since the market topped in 2007. And back then, just like before every other top, we saw a sharp rise in long-term interest rates. We saw a rapid increase to record highs in margin debt, and we're seeing sort of the same thing right now. Interest rates, the 10-year Treasury is still under 3%, so we can't say on absolute terms it's very expensive, but when you think a year ago it was 1.6%. So we've gone from 1.6 to, what are we today, 2.9. That's a 50% increase in interest rates. That's significant, and I think it's a significant warning sign. And then last month, the New York Stock Exchange just released their numbers. Margin debt hit a new high, $412 billion. It's the highest it's ever been. 2007, margin debt hit an all-time high of $385 billion, I think in July, and the market peaked a few months after that. So there's a handful of warning signs. I don't want to say that we've definitely hit a top, but I think investors need to be on the lookout for it. And
the margin debt, meaning speculation, optimism, they're borrowing to find return. Is that?
Well, yeah, exactly. Using margin is basically borrowing money to invest in the stock market. And, at first glance, it seems kind of smart because, you borrow money at 2%, invest in the stock market, and this year you've made, more than 20%. That seems pretty smart. But, the market has a way of humbling folks who seem pretty smart. And the problem occurs when you borrow money to invest in the stock market and stocks go down. Then all of a sudden you find yourself having to liquidate stocks just to pay off the loan. And that's usually where you get those crisis conditions, those things that set up the fall in 2008. The fall in 2000, 2001. Again, all of those things seem to happen right about the same time as markets top. And so that's something that I think investors need to be on the lookout for. And the fact that most people aren't talking about this situation, or most people, when they do talk about it, they sort of wave their hands and say, it's going to be different this time. That concerns me because it's never different. Things always seem to repeat.
So this top, are you thinking next year, next month? What's your gut?
Well, I told subscribers a couple of weeks ago when the S&P I think gets up around 1813, I said, boy, everything seems to be lining up for that. And nobody rings a bell at the top of the stock market, but the fact that you had Twitter just go public and phenomenal valuation, I think that's another warning sign or even a bell ringing. I'm very concerned. I think we're probably no more than a few months away from the top of the market. If it turns out that 1813 wasn't the top for the S&P, I think we're awful close to it right now. And so I'm looking for opportunities to go short. The only area that I like from a long-term perspective from a buy side is the gold mining stocks. And most of your listeners should probably start laughing at this point because gold miners have been a horrible, horrible investment the last couple of years. And this year I think they're down on average about 50% with the stock market up better than 20. But again, from a contrarian point of view, that rubber band is stretched about as far to the downside as it can. And so I'm looking at buying those and pretty much shorting everything else.
Okay. How can listeners find your research?
Well, Stansberry & Associates publishes my research. And you can go to their website. It's www.stansberryresearch.com and just look for the short report, and there'll be links to all sorts of descriptions of my work and some of my articles in there. Listeners can also look at some of the free e-letters we send out. That is www.growthstockwire.com, all one word, linked together. And I publish there a couple of times each week.
All right. Is there anything you'd like to add before we go?
No, I think we're probably in for a little bit of rough sledding in 2014. But one of the great things about the stock market is folks can make a lot of money even if stocks fall, because it's not what you do or the decisions you make in bull markets that you make you rich. It's what you do during the bad times and the opportunities that present themselves. And I think we're headed for one of those wonderful opportunities.
Thank you for your time, Jeff.
Great. Thank you, Lance.
Today's guest has been Jeff Clark, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarak at the MTA, reminding you that price is always right.